We are overweight equities, moderately so, relatively close to our strategic long-term targets. Supporting this view is a solid economic backdrop, growth that is above trend. Income levels are very high. You see wealth increasing. The consumer is in very good shape coming out of this, and particularly they have amassed kind of this war chest of savings that puts them in a good position to spend. And we expect that as the economy reopens. We've already seen that. We expect that to continue. But most importantly, we expect earnings to be very strong. The low rate environment, even though rates are expected to go higher, it's still a very low rate environment, and that is also very supportive for equities. There are risks out there. Valuation is somewhat rich. Inflation is a key risk. We expect that to be more persistent than a lot of people have expected. That we don't expect a return to kind of hyper inflation levels. There are margin pressures, there are supply chain issues driving inflation up. There'll be wage pressures. It's been hard to get some people back to work, so wages in certain sectors are going up. But most importantly, the overweight in equities is relative to fixed income, and with rates low and most likely heading higher, we expect equities to outperform fixed income. Within equities, we favor domestic over international. If you look at the US, it has been further along coming out of the pandemic recession than most other economies. US companies just have stronger profitability, stronger earnings growth, and very good long-term projections. Internationally, most of the world is lagging behind. They will catch up. Vaccination rates are catching up. And we expect eventually to get this more synchronized global growth. While we're underweight international, we are within international overweight Europe. And partly this is the expectation that Europe will start emerging more rapidly. You've seen vaccination rates go up significantly within Europe. They're starting to reopen. The European economy in general is more cyclical than the US. We are underweight emerging markets. It is dominated, however, by kind of Southeast Asian markets. In particular, China is about 1/3 of the emerging market indices. If you throw in South Korea and Taiwan, you're up to well over half. And China in particular, growth is still solid, but it's been in a slowing trend. And there are concerns about the level of stimulus they are willing to use to kind of prop up economic growth. Debt levels in China are very high. And also within China, there are other issues. There are growing geopolitical risks. There are tensions with the US over trade. There are tensions with the US and Europe and other parts of the world over human rights issues. And then the general geopolitical backdrop within Southeast Asia is tense. So overall, we're underweight China, which is a reason to be underweight emerging markets. And other smaller aspects of the emerging market, their vaccination rates are lower. They're struggling more with COVID. Kind of moving on to capitalization, we are overweight large and underweight small. Small caps did very, very well coming out of the recession. Small caps from like November through the first quarter had a very, very strong run. You've seen that flag a little bit more recently, and they've been underperforming large caps for much of the second quarter of the year. And part of that is very much tied into the same trade, the reflation trade. And small caps that do best overall coming out of a recession, but in a more sustained, steady growth period, large caps should do better. So we expect that trend to also be supported by kind of the dominance of technology within the large cap space. And you see secular trends that emerged during the pandemic that should continue, an increased digitalization of the economy and automation of the economy, particularly in the service sector where it's very hard to source workers right now. Again, we expect there to be volatility. Small will do well, particularly as at times, but over the longer run, we're overweight large caps. Value growth is another area I'd like to touch on. You saw value do very well coming out of the recession. Again, once the reopening became possible. You saw the pandemic hit areas of the economy do extremely well and value significantly outperform. That has flagged again, particularly over COVID uncertainty. One of the reasons we like growth is just we think there are a lot of trends that support secular growth. Like I said, the move toward technology, secular growth is attractive in a high debt economy, and debt certainly has gone up in the United States on the government level. And also growth is very well in a low rate environment. You see deglobalization. So all these support secular growth over value. You will continue to see chop, however.